Hello and welcome to a long Christmas video, which is going to be rich with information because I'm going to be bringing you more than a couple of charts, macroeconomic overview of what has changed and what the consequences of Fed policy moves are going to be, what is the status of the US economy, and why all stock market and real asset investors should care, what we can expect, analyzed macroeconomically, and very much from the traders and investors point of view. So, without further ado, you know my site, the full scope of what I do for you for so many years. Thank you for liking these videos helps tremendously, so thanks again, commenting, subscribing to this YouTube channel, and remember that following me on Twitter, Telegram, and being signed up for a free account on my site forms the basis. So, first the promised big picture. What we are seeing macroeconomically unfolding. After the 10-year reached my corrective target, yields started rising again. That has bullish consequences for US dollar. What the Fed is doing is that it's shrinking its balance sheet while simultaneously cutting, and after the missed July cut, resulting in no cut, we saw the panic 50 point in September, and now the hawkish cut that I called for to happen on Wednesday. But what is new and what is tremendously important is having a look at what the Fed is going to do at the turn of this year within its repo facility. Remember that this beautiful four-letter acronym is no longer with us, and regional banks are on their own, which is why we see financials performing the way they do lately. I will dive more into the details later on. As the second bullet point, let's examine inflation. We have surging PPI, which is inflation in the pipeline, not yet reflected in CPI, which is kind of concerning given that companies would like to pass on rising costs to consumers. We see quite a few tariff prospects as the new admin takes its place. Prospects similarly for rate cuts, deregulation, DOGE, and the latest news is the wildly trimmed down bill from 1,500 pages to some 120 only, doing away with all the pork, averting government shutdown midnight going into this weekend. So, what does the bond market think about all of this? As I had been arguing for a very long time, we are not going into any kind of recession. Consumer is reasonably resilient, and the rising rates reflect both inflation prospects, slowly rising productivity, and economic acceleration coming in first half 2025. So this is having implications for what the market expects for inflation to be and what kind of rates it's going to be demanding on basically both ends, because the Fed is less than ready to be cutting and down to 2 cuts, or who knows how many that's going to be actually turning out in next year. That's been quite a surprise that equities have not shaken off Wednesday during the conference, and you had reviewed early Thursday video which explained in great detail the consequences and what has actually happened on the last FOMC of the day. As well, in my view, we are facing more domestically produced oil supply hitting the markets next year. And on the other hand, rest of the world, emerging markets and China, which was what I had been diving into when it comes to emerging market bonds and talking China for around a week already, we see notable markdown in their expected consumption growth. And that's this supply-demand dynamic is exerting effect on oil prices. And that's what I had been arguing for over a month ago, that the new administration is not necessarily bullish. Make a crossover, necessarily not bullish for oil prices, because first we are going to be seeing high increased supply pushing down prices, and then that clears up those who are not able to produce profitably at those given price levels, and the cure for low prices is low prices, and so on. You know the saying. So first we will see oil prices under more pressure, which is quite a difference to the environment of 2022, because it's quite tempting to be comparing these two macro situations when you look at yields and dollar, as you will hear me covering next. So we are seeing Fed cutting rates, but yields in the market yields, they keep climbing. So the bond market is doubting the Fed's message, or maybe it is just telling us what I had already told you right now when it comes to recession, that we don't need for economic growth Fed rate cuts, that the economic growth is going to be coming in first half of the next year anyway. So this is the difference from the stagflationary 1970s, and I'm not in the camp of us getting into a stagflation next year. Next year, when we are going to be focusing on the first half of the year. So that's how you should be understanding when I say next year. Remember that everything in the markets and in finance, it's a confidence game. So what the Fed is, what the bond market is telling the Fed by not seeing rising bond prices and seeing actually rising yields, because these move inversely, is that there is some faith being lost in the Fed's inflation fighting ability. I haven't heard a clear explanation of why the rate cut on Wednesday happened, when we see all the signs of inflation getting ready to turn up its head, and the end of long disinflationary period that I termed for quite a while as being long in the tooth, drawing to its natural end. So this is about whether the bond markets at one beautiful day later on, this is months down the road, this is not a matter for the next couple of days or even January, February. It's about whether the bond market does or does not lose faith in Fed's inflation fighting ability. So we are seeing yields rising, but this is no Tina, there is no alternative of the late prior decade that was so characteristic of the slow rate raising path of the Fed before Powell was served a humble pie on Christmas, before Christmas 2018. So this is as well not the reverse repo crisis of autumn 2019. So we are seeing yields moving up, and then comes the next important concept, which is equity risk premium. Investors always decide whether to allocate their money into the stock market, risk assets in general, or into the bond market. And the bond market has its risk-free rate of return, which is the rate of return of treasuries. And when these are pushing higher, the 10-year is well over 4.5%. That is competition to risk assets. And they are already at quite high valuations. And we are seeing quite a few signs of companies being punished by the market for lowering forward guidance when it comes to earnings growth. A perfect latest example, Macron. That's the defining factor. This will intensify even more as we go forward, and yields keep rising. So, as said already in the points before, it feels like we are kind of entering the 12-22 situation when USD is rising, yields are rising, and this combo is bad for global liquidity, for global money supply. We already saw Bank of England as being the first in not cutting. So you had heard me as well feature lately in the YouTube videos and in the daily articles the emerging markets bond chart. We have heard me tweeting often about China boom and bust cycle, and how each intervention is being sold, and how domestic Chinese have very little confidence in these interventions actually turning it around. And you know my points about China inflation numbers, and not a recession, but distinctly lower growth rates that the second largest economy in the world is flirting with. So USD going up is bad for global liquidity, and as well that affects commodities, that affects industrials, which had been on a long losing streak. Financials have not been performing well. Oil I have covered. Gold is relatively more resilient than silver or copper. Copper is underpinned by the AI revolution, so that's kind of cushioning the red metal, but the effects on commodities, out of which agri-foods remain the best performing island. That's what I had been amply covering for clients already. So this is the big picture, and the next part I will just dive into the charts. Here you can see a very important one. This is the Fed balance sheet, and you see that liquidity is still contracting. So that's not exactly a positive sign as we go forward. The next one is the reverse repos. You can see that the intervention at the turn of the year, slated for several trading days, when the Fed is correctly worried about a lot of liquidity being withdrawn from risk assets, meaning that they are afraid of a risk of turn continuing in the markets. I will come back to what Friday's price action was and explain it in the following charts. But for now, let's stay focused with the reverse repos picture. and that the 5-day approximately intervention is going to be bringing up to $500 billion into the markets, into an otherwise very low volume trading days. So it is going to be having a pronounced effect, a temporary effect. So be ready for a volatile trading session starting Monday. So this was to show you that this is more than the first horizontal line higher, which is basically one of the, you get the point. The following chart is still the relaxed financial conditions index. And do you think it will get even more relaxed? Compare that to mid-1221 and how the conditions had been getting progressively worse. Remember later on, all the Credit Suisse and similar liquidity crisis and how it started affecting the periphery. And in my view, this is what we are going to be going into in the following year. We are going to be entering a harder to come by, not so easy money times. And this will be together coming back to the equity risk premium and the competition from risk-free return on treasuries. This will be a competition to risk-on assets, asset prices, equities that will keep elite and serve as a very powerful headwind for stocks. Here you can see the daily chart of the 10-year yield with the 2-year one overlaid. Why this Friday's dip? We got slightly better core PCE reading. Is it a game changer? Compare that to the Wednesday's long white candle on what Powell did and how he delivered it. The clarity with which his message was conveyed. This does not compare. Yields are still going big picture higher, and they will surpass 5% again. It's a matter of weeks, relatively few months, rather than just a couple of weeks. Not a couple of weeks, it will be a question of first quarter, I guess. So that's a comparison of the relative importance of what is the larger framework of Fed monetary policy and how it changed Wednesday compared to one single inflation reading that the Fed likes to follow. The next chart is the dollar one. We see some more hesitation, but remember that on Wednesday the dollar was the first to move higher even before yields did. So I expect this as well to be reversed on this chart. And in the caption, in the chart caption, you see all the reasoning given the resolution. I will just read it out. The dollar is going higher, way above the prior high of 108. And if you remember back in the period that I had been referring to, 22, it was 112, 113, say. So we have government spending optimization initiatives, deregulation, tax cuts, we have rising productivity, still confident consumer, rising auto sales, decent retail sales, red hot services PMIs 58.5. These are not contractionary values. These are not nothing hinting to a recession approaching. We have tariffs approaching, tax cuts, and already mentioned the deal averting government shutdown. Bottom line, the real economy is accelerating, but it will not be without turbulence in asset markets. And that's what we have to be as traders and investors very much alert to. Before the opening bell on Friday, I warned about a short squeeze that is going to be developing as a result of the beat in core PCE figure. But the real question as expressed on this 4-hour chart of S&P 500 is whether it anyhow changes the picture itself. Did we see positioning with more buying into the close? Not exactly. We had seen a reversal right off my 6,050 level at on March ES futures, and you should be as well looking at quite a few insightful ratios or sectoral chart overlays that I'm running through on a very regular basis, practically a couple of times every single day, every single trading day. That's the discretionaries to staples ratio. How well did the interest rate sensitive sectors do? That's real estate and utilities. Was it accompanied by yields going down, retreating much? They are not. So the chart and macroeconomic picture would clearly favor sellers down the road. But then again, there is this turn of the year, $500 billion, potentially up to $500 billion of fresh money hitting equities, and that will be done into a low volume couple of sessions. So what we should do is inspect how markets behave in this very tricky period, because what would make sense macroeconomically and fundamentally does not mean that it would translate into immediate chart price action, even if in chart terms, as per technical analysis, that would be making most sense to happen. On the MACD histogram, you see that the uptrend, the turn, it's not anyhow positive. So this is a question of Monday follow through or not, and then between Christmas and New Year, how it goes. So I'm just cautioning you into how we should approach the following week. The next chart is the very same one for our, except that it is for Nasdaq. Do we see tech outperforming, which would be a basic ingredient of bull markets when financials as the second most habitual leader are badly lagging? No, we don't see tech leading. So that's why I'm still leaning towards this being just a very, very violent short squeeze exacerbated by the final OPEX, the final big grade OPEX this year that made for Friday's volatility, coupled with the short squeeze, it just amplified it. So we don't see tech actually leading to the upside. And as I did on the preceding chart, I inserted my tweet, which is this time about what we should as traders do about it. The first decision is what would be the time frame that we are trading on, what kind of moves are we interested in, whether we want to go against the grain and try to ride the counter trend short squeeze without knowing how far to the upside it's going to reach, or whether we want to be positioned with the big picture trend and the macro shift that has happened through much tighter than expected Fed Wednesday, as Powell did out-hawk the expectations. So this is about choosing your game and sticking to your game plan and not sweating every move, however violent and volatile it's turning out to be. Final chart that is from the big index section is the Russell 2000, and here you can see the greatest relative weakness, the greatest relative still distribution. The prior two indices have overcome their feeble post-FOMC Thursday pre-market tops, intraday tops. This one has been able to only test it, and it's still reflecting, and it's still telling us much about what it thinks yields are going to be doing forward. They are going to be still rising. They are on an uptrend. See how real estate and utilities were performing, whether their great boost, outsized boost Friday is in your view sustainable or is it not. See how financials and regional banks, KRE, had been performing Friday. That's another sign of stark relative weakness. So that's as well not a vote of confidence in this upswing, which I call just a very violent short squeeze. This is just one sample of the sectoral overlays that I follow on an intraday basis. So this is just a very rough inspiration because I'm switching between several views, and this is just one of them. But what I want to point out on this positioning Friday is that we saw the dollar rising into the close, financials diving, and you see discretionaries going down, which is not at all good. And Nasdaq is the lowermost reddish line, and I'm running SMH because it is heavier on Nvidia, which is arguably the most important company for the US stock indices. So in neither of these three you see any kind of outperformance, leadership, confident buying into the close. And S&P has been elevated by the rush into defensives, utilities, real estate, which had been keeping it relatively up, but you see all the rest being positioned on a very cautious note. So let's see what kind of an impact when this up to $500 billion fresh money hits the markets at the turn of the year starting January 30th. What kind of pre-positioning are we going to be experiencing in the days leading up to this? So I hope that you had enjoyed this long presentation. On the join page on my site, you will see a helpful introductory part helping you to choose what kind of my premium services would be the best fit for you personally based on what you trade, how you trade, what you invest into, how you invest into. Thanks again for liking this video, subscribing to the channel, following Twitter and Telegram keenly, and remember that the free account on my site is the basis. There is more crypto coverage done by Eleni within our intraday channel on equities, and you see the daily analytics that pair so greatly with all the extra intraday work when new data after the market open hit the wires, what I do within the intraday channel and what kind of nimble turns it allows us to take advantage of. You pretty well know my trading story, my biography. Be aware of all impersonators and the obligatory disclaimer to close off this long presentation. Thank you very much and have a beautiful pre-Christmas weekend filled with whatever matters to you the most. Forget not about the spiritual.